We stand for the true and north, the cities and skylines, the strong and free. For those who value the story and source, the opinion and fact, the context and clarity, to help illuminate the path and potential, the drive and direction. We are the one and only, the Globe and Mail. What shapes your world?
Hi, everyone, and welcome to the webcast. I'm Rudy Mazzetta, reporter with Globe Advisor, and I'm pleased to be your host and moderator today. Before we get started, I would like to acknowledge that the land on which the Globe and Mail is headquartered, situated, is the traditional territory of the Wendat, the Anishinaabe, the Haudenosaunee, the Métis Nation, and the Mississaugas of the Credit First Nation. We're grateful to have the opportunity to work and live on this land. Now, over the next hour, we will look at how to save more of your money through leveraging common tax strategies, such as income splitting and tax loss harvesting, and maximizing the value of your registered retirement savings plan, your TFSAs, other registered plans. Today's event is presented with support from Edward Jones. We are pleased to have a representative from Edward Jones on our panel today, along with other speakers who are sharing their views independently. As we go along, please type your questions into the Q&A box on your screen, and we'll get to as many as we can a little later on. Let's introduce our tax experts. First, we have Julie Petrera, Director of Financial Planning at Edward Jones. And next, we have Amin Mawani, Professor of Taxation and Schulich Research Excellence Fellow at York University. And finally, Jason Heath, Managing Director at Objective Tax and Accounting, Inc. Hi, everyone. Thank you for being here.
Hello.
Thanks for having us.
Yeah. So let's dive right in. I wanted to look at deductions and credits. I mean, many of us maybe did our tax returns this long weekend. Julie, could you go through, just as a reminder, what's a credit, what's a deduction, and how are they valuable to us?
Yeah, sure. So a deduction reduces your income and a credit reduces the tax you pay. So a deduction lowers your taxable income, thereby lowering your tax. If your taxable income is higher because you are in a higher marginal tax bracket, the deduction is worth more to you than when your income is lower. So for example, if you earn $70,000 and you have a $5,000 deduction, your taxable income is lowered to $65,000 and you pay tax on $65,000 rather than $70,000. If your marginal tax rate is 30%, a $5,000 deduction saves you $1,500 in tax. Some common deductions or common things that give you deductions are RRSP contributions and FHSA contributions. And a credit, right, lowers the amount of tax that you owe after your income is taxed. If you owe $3,000 in tax and you have a $1,000 tax credit, you would only pay $2,000 in tax. And credits can be refundable or non-refundable. A non-refundable credit, just like it sounds, it can reduce your tax to zero, but it cannot go below that. So you can't get a refund as a result of a non-refundable credit, whereas a refundable credit could result in a refund. So credits can be more valuable, right? Because a $1,000 tax credit is worth $1,000 and a $1,000 deduction is worth a portion of $1,000 depending on your tax rate.
Got it. Thanks. Amin, what about for 2025 or 2026? Are there some new credits or deductions that we should be mindful of?
Yeah, starting 2025 tax year, there's an Ontario-specific fertility treatment tax credit, refundable, 25% credit of up to $20,000 spent on fertility to a maximum of $5,000. And for 2026, there's a personal support worker tax credit, 5% of amount spent up to a $1,100 maximum.
Okay, thank you. Jason, one thing that's always interested me is, when I get a deduction, I want to take it right away, right?
Most
But
people, yeah.
you can, but you don't have to. And I wondered
Yeah.
if, from a high level point of view, the idea of maybe carrying forward a credit or deduction, or in some cases, maybe carrying something back. Can
Mhm.
you walk through that?
I agree with you. Most people claim their deductions and their credits right away. I think probably one of the more common deductions that you might carry forward is an RSP deduction. So you report an RSP contribution in the year that you make it, but you don't need to deduct it in that year. You can actually carry forward an RSP deduction and claim it in a future year. Say, for example, if your income is relatively low, you contributed to your RSP, but you want to save that deduction for a higher income year the next year. Another one that is a little bit different is a capital loss. If you sell a taxable investment in a non-registered account for a loss, you sell it for less than you purchased it for, you can carry back that loss up to 3 years to offset previous capital gains and get a tax refund for a past tax return. Or you can carry forward that capital loss indefinitely into the future to claim it against a future capital gain. Probably the most common one that we see is young people in particular who have tuition that they pay for college, university, trade school. And if their income is relatively low, they may not claim that credit and they can save it and claim that credit in a future year, carry that tuition credit forward for a higher income year down the road.
So that's maybe something, Jason, that you want to talk with your accountant. Maybe, uh, if you're using an accountant, maybe it'd be good to defer it.
For sure. And if you're doing your own tax return, you may or may not get a nudge from the software that you're using, but I think it's important to understand tax deductions, tax credits, as Julie outlined off the start, and know which ones you can actually carry forward and why you might want to do it. So if you're doing your own taxes, you need to make sure you understand these things.
Yeah, thanks, Jason. I wondered if we could talk, about our next topic, which is income splitting. And from a high level, what do we mean by income splitting? What are we trying to accomplish? What's the concept there?
Yeah, like many other countries, Canada has a progressive tax rate system, which means tax rates go up as you earn higher income. So the tax on one person earning 100,000 is a lot more than tax on two people earning 50,000 within the household. The difference between those scenarios would be about $7,500 in taxes. So first you need to know what your marginal tax rate and your average tax rate is. So I found the eytaxcalculators.com to be a very good source to give you your average and marginal tax rate. So there's several strategies that one can implement within a couple. So we could let, for example, the higher income spouse pay for all the groceries and the mortgage payments, and let the lower income spouse do all the saving in his or her own name. So they're taxed at his or her lower tax rate. One could also plan later on for the higher income spouse to earn more lightly taxed capital gains in their portfolio, and the lower income spouse holding more heavily taxed interest income in their portfolio. Another approach, if I can go, is the family loans at prescribed rates. Right now, the prescribed rate in this quarter is 3%. So if the highly taxed spouse has an opportunity to invest in a 7% investment, he or she could instead lend the money to the lower tax spouse at 3% and let the lower tax spouse invest at 7%. That allows 4% of the income to be split from the higher income spouse to the lower income spouse.
Right. Thanks, Amin. Julie, I wondered, just to carry on from what Amin said there. I mean, one thing we're trying to avoid is this idea of attribution, that you can't just, for instance, I can't just give my spouse money. Amin talked about the prescribed rate. I can't just give her money to invest. That has to be structured as a loan. So I wondered if you, don't want to put you on the spot here, but just the attribution rules a little bit, how, what we're trying to avoid here.
Yeah, so so the person whose money it is the person that's responsible for the tax on it. So there are various strategies, and Amin explained one of them, right? So having the higher income spouse pay for the household expenses so that the lower income spouse can invest, and then they earn the returns and pay tax at a lower rate. In your working years, another way that you can income split is through a spousal RRSP. So the spouse, the higher earning spouse, if there's a disparity in income, the higher earning spouse can contribute to the spousal RRSP of the lower earning spouse, so that they get the deduction at the higher. So we know that deductions are worth more to higher income earners. The higher income earner gets the deduction at their higher marginal tax rate, and then the lower earner will pay tax on their marginal tax rate at withdrawal. In the spirit of attribution, if you were to do that and then the lower earning spouse was to withdraw it within the first 3 years, the income would attribute back to the contributor. So that's one way that's an attribution rule. That's a rule to make sure that you don't just put money into their spousal RRSP and have them withdraw it immediately.
Right, got it. Jason, I wonder if you could talk about like income splitting opportunities at retirement, just maybe the big high level ones, just to sort of remind our viewers of what they are.
Well, I think sort of the main income splitting opportunity in retirement is pension income splitting. It's been around for about 20 years, Rudy, and certain eligible pension income can be split with your spouse or common law partner. Defined benefit pension income, RRSP withdrawals don't count, but if you convert your RRSP to a RIF, a registered retirement income fund, and you're 65 or older, your RIF withdrawals are considered eligible pension income. And the way that it works is when you file your tax returns, up to 50% of your eligible pension income can be moved onto your spouse's tax return. You claim a deduction, which again reduces your taxable income, and your spouse or common law partner claims an income inclusion of the pension income that is split. So that's quite common to do, and it's something that you can do retroactively. So again, you do it in April when you file your tax return, but certainly over the course of the year, it's something you should be planning. You should be trying to model what your incomes look like, what your tax is going to look like, and that's where retirement tax planning can fit in very nicely to a couple's financial strategy.
And Jason, just to follow up, how about like sharing CPP? Is that a way to do an income
There is a
split?
way to do that. When you apply for your Canada Pension Plan, retirement pension with Service Canada, you can ask Service Canada to split your credits. And basically what they will do is they will look at the contributions that were made during the years that you and your common law partner or spouse were together and divide them effectively. So if you have one spouse that contributed more, in an extreme scenario, one spouse that didn't contribute anything potentially to the Canada Pension Plan, that splitting of credits allows the lower income spouse or the lower, contributor spouse to receive a higher retirement pension. So that helps a little bit as well. That's something you can do proactively when you apply between age 60 and 70 for your CPP pension. And eligible pension income does not include CPP. It's defined benefit pension income, RIF withdrawals, etc. And you deal with that retroactively.
Got it. I wonder if we can move on to our next tax loss harvesting. We sort of touched on this in an earlier answer. And Jason, I'm going to go to you again here. Can you just, from a conceptual high level point of view, talk about what are we doing? What are we harvesting here? What's tax loss harvesting?
So if you've got investments in a taxable investment account, a non-registered investment account that are trading at a loss, their market value is lower than the purchase price for the investments, you can intentionally trigger a loss by selling them. That's a capital loss. And the purpose would be to carry those losses back up to 3 years to offset previous capital gains, to offset capital gains that you have in the current year. Maybe you're looking at your buying and selling activity and you see that you've got a large capital gain and you're looking at your portfolio to try to sell things at losses to reduce that income inclusion. But it's intentional triggering of losses, often towards the end of the year when your capital gains and your income situation is more obvious.
All right, thanks, Jason. Julie, I wonder if there is something we have to watch out for when we're doing tax loss harvesting, and that's the superficial loss rules. And how do they work? I mean, I'm especially curious about the fact that it's like 30 days before, 30 days out. Like, how does that all work?
Yeah, so the superficial loss, so what CRA is trying to do is ensure that you aren't selling an investment just to trigger a loss for tax purposes and then rebuying the exact same investment. So if you were to do that, or it appeared that you did that, the loss would be denied. And so what you need to do to avoid the superficial loss rule is wait 31 days before repurchasing investments, right? So the loss would be denied if you or an affiliated person, so even your spouse or a corporation that you own, was to buy identical property 30 days before the sale or 30 days after the sale. So this would appear again that you're just selling to trigger the loss. So by waiting 31 days after to repurchase these investments, that's one way to avoid that. Another way, if you don't want to be out of the market for 31 days, is to buy a similar but not identical investment. So you don't want to be out of the market, just don't buy a remarkably similar investment. Buy something that works with you from a suitability perspective, that meets your goals, but that's not identical from CRA's perspective.
Got it. Julie, just as a follow-up, what happens if it's like my spouse that buys the same?
Yeah, an
You know, I
affiliated
sell it out?
Yeah, you can't do that either. So any affiliated person, a corporation that you own,
Right.
or a spouse would be the same. They would apply the same rule, a superficial loss
Right.
applies.
Got it. Got it. Amin, I wondered if you could start us off on the next topic, which is on registered plans. We're doing a big chunk on registered plans. And, you know, a question that everybody has, um, you know, sort of at the beginning of the year is, do I direct my money toward my mortgage to pay that down or to an RRSP? And I think that's a tough question for people. And how can they approach that?
Yeah, this is one of the more common questions posed by investors. So we have to really look at pay down of any debt, including mortgage, as an investment decision. For example, if you had $100 debt and $100 loan, and if you at 5% interest rate, 1 year from now, if you repaid the loan, you would have to pay $105. So that's analogous to having an investment where if you paid $100 now, you would not have to pay $105 1 year from now, and you would therefore earn a 5% return. So if a mortgage has a annualized return of M%, then by paying it down, you're earning M% per year. So if you have a 5% mortgage, you're earning 5% by paying it down early. Now, RRSP also has tax sheltered returns, and let's say they offer R% per year. So then your decision is choose the higher of M or R, whichever is higher, the mortgage rate or the RRSP rate. And by RRSP, I include other tax shelters as well. Keeping in mind that mortgage, both are after-tax rates. Mortgage is a risk-free return. It's your own investment, whereas RRSP returns might be a bit risky depending on where you're putting your money in.
I see what you mean. Julie, I think another question that people have is, and I've gotten this many times, being a tax reporter, I have colleagues asking me about all the different registered plans. And, I don't have money to put into all of them. So how do I order them? And I know that the situation is really different for each person, but is there a way of sort of thinking that through?
Yeah, it's a good question. It's a question we get often now, right? As people get tax refunds, even the previous question, mortgage, pay down debt, pay down debt, invest, and then invest where. I'll just add on to what Amin said too. I would add a couple non-financial considerations that are very important. Your comfort level with debt, right? And your risk tolerance. We always want to consider those in making that decision. And when we're considering debt or mortgage versus RSP or RSP versus TFSA versus FHSA, consider matching. So if you were to put money into an RSP and your employer was to match it, is there free money on top of the contribution? Because that changes the math that Amin just outlined. So you might want to make sure that you consider if there's any matching. We know that also if you were considering an RESP, a registered education savings plan, if that was one of the plans in your comparison, that there could be matching grants associated with that, which may accelerate the value of that. I'd also consider your time horizon. So a TFSA, no deduction on the contribution, whereas an RSP has a deduction on the contribution, which is great, but an RSP might be used for retirement or might have a longer time horizon. If you don't have an emergency fund and you're looking to have some money available or some money that you might use in the near future, a TFSA might be better. So these accounts have different levels of flexibility, different rules, different tax consequences. One more consideration is an RSP and an FHSA, you do get a deduction for the contribution. Jason explained that you don't need to use that deduction right away, but if you did, and it resulted in a tax refund, that might accelerate the amount that you have to invest, or you might take that tax refund and pay off debt. So you might be able to contribute to more than one goal.
Great, thank you. Amin, I wondered if you could talk about spousal RSPs, and I think we talked about it a little earlier, but it's interesting because I think I've had the questions, I see it online sometimes in discussions about whether they're still valuable with, like pension income splitting. What is a spousal RSP, and what are maybe one or two ideas for how they, how to approach them, how they can be used?
Yeah, so spousal RRSPs are explicitly an exemption from the attribution rules, where it allows for the higher income spouse to contribute and deduct from his or her income an RRSP contribution, and the lower income spouse can then save in his or her own name and withdraw, as long as they keep it at least 3 years without withdrawing. Then it becomes the owner's property, so the lower income spouse's property. So this allows for a lifelong of income splitting, and that can amount to a lot. For example, if the tax on one person earning $120,000 of retirement income each year is $27,000, the tax on two people earning $60,000 each in retirement income is $17,000. The difference is about $10,000 a year, which would require about $200,000 of additional RRSPs to give you that kind of payoff. I'm assuming a 4% return and a 30 years guaranteed annuity. So income splitting on a regular basis allows incomes in your retirement years to be more equal. And that kind of splitting also helps you with any old age security clawbacks and other things.
Right, to try to keep your income below that clawback level, to manage it. Jason, readers are always interested in housing and how they can build up a down payment. I wondered if you could talk about the home buyers plan. I mean, it's a very well-known plan, but I wondered, how it works and maybe what some of the things that people should keep in mind when they use the home buyers plan.
Sure. Basically, the home buyers plan is a way to leverage your RRSP account, your registered retirement savings plan account, to purchase an eligible home for a first-time home buyer. You can contribute to your RRSP as much as you want based on your RRSP room. But then you are allowed to withdraw up to a maximum of $60,000 from your RSP under this HBP home buyers plan. And the withdrawal is tax-free. So you get tax deductions as you contribute to your RSP and tax refunds, which helps you with your saving ability. And then the $60,000 withdrawal is tax-free as long as you qualify. And again, it's you're an eligible first-time home buyer, and it's a home that you're going to live in as your primary residence, not a rental property or something like that. And 2 years later, you need to start repaying 1/15 of the withdrawal. And over time, the money gets contributed back to your RSP. But again, it gives you a little bit of a bump in terms of the down payment that you can put down, and then you can catch up with contributions over time. If you don't make the 1/15 repayments over 15 years, the amount gets added to your income in that year, and you lose that RRSP room forever. So something to keep in mind, but just one of the tools in addition to FHSA's first home savings accounts that Canadians can use to buy their first home.
And I guess you can use it with, if you're buying with a partner, you both can access home buyers
Both
plan.
can use it, and you can both use FHSAs as well. So there's a lot of different ways that you can
Right.
multiply down
Yeah.
payments to be able to put down a larger amount.
Right. Julie, I wanted to ask about RSP loans. I hear about them every year. I mean, we've gone through the RSP season, but could you, walk me through the idea there and when they might make sense?
Yeah, so an RSP loan would be borrowing money to put it into your RRSP. Because you get a deduction on the contribution, the loan is not tax deductible. The interest on the loan is not tax deductible. Whereas if you were borrowing to invest in a non-registered account, it would be. So that's one consideration. There are still plenty of times when they make sense. One example might be if you are in a high tax bracket this year, or you have a high marginal tax rate this year, the contribution this year could result in a significant refund or a big deduction, especially if you think that you're going to move to a lower tax bracket next year or in the future, and this is the year you want to make a contribution. You want to contribute as much as possible. It might make sense to take a loan to do that. If you're able to repay that loan quickly, you might also want to use some of the money from the refund to make a repayment toward the loan. And if you can get a low interest rate on a loan and you think you're going to earn more on the RSP than you're going to borrow, those would be positive reasons to consider that. Again, caution, interest is not tax deductible. There is a debt obligation. You have to be able to make these payments regardless of the investment performance. So even if you were to lose money on the investments in the RSP, you still have to repay that loan in full.
Got it. Thanks, Julie. And I wondered if you could start us off on the next section, which is TFSAs. They've become very popular in the last few years. People really like the element of, tax-free withdrawals at the end. But a problem that seems to come up every year is this idea of overcontribution. So I wondered if you could say, like, why should we avoid overcontributions? How do they happen, and how do you fix them?
So the tax-free savings account has an annual limit. So for 2026, it's $7,000. If you were over 18 in 2009 and never contributed, it's $109,000. But the overcontribution, this happens for a few reasons. So if you're, the limits have changed annually, they've gone up and then down. So you'd have to have kept track of those. But what a TFSA does that, say, an RSP doesn't do is if you withdraw from a TFSA, you get the amount withdrawn added to your contribution room the following year. If you were to contribute it later in the same year, that would be considered an overcontribution. Overcontribution, so any amount over your personal limit, it would be subject to a 1% tax. So if that happens and you realize you've overcontributed, you want to take that overcontribution out. So withdraw the overcontributed amount as soon as possible to stop paying that penalty. And you can also there's a form that you can file to request a penalty waiver if it was a complete accident or it's a reasonable error.
Yeah, and that's 1% a month on the
Per month.
Yeah.
That's about 12.7% per year. So it's
yeah, that's
quite
a lot.
prohibitive.
Yeah. Jason, I wondered if there's any ideas about sort of using RSPs and TFSAs together, and in a way that either as as a way maybe you counsel your clients, or maybe your clients ask you about. Is there a way of using them to sort of maximize tax advantage?
For sure. I think in an extreme example, if somebody's maxed out their RRSP, they definitely want to be contributing to a tax-free savings account before they build up money in a taxable non-registered account. In the other extreme, if somebody's got a relatively low income and they've got a choice between contributing to an RRSP and a TFSA, I might be more inclined to lean towards a tax-free savings account, because the RRSP contributions, the deductions rather, are not as advantageous if your income is low and your tax refunds are low, particularly if you might pay a comparable or even higher rate of tax in retirement. You may lose access to government benefits. So again, TFSAs may be better than RRSPs for somebody with a relatively low income. That assumes they don't have access to a group RSP where there's a matching contribution, for example. And often for young people that are just starting to build money up, if we ignore options like first home savings accounts, FHSAs, if you want to have a little bit more flexibility, a TFSA can be a more flexible account, particularly when you're young. And there's no reason that you can't take a TFSA withdrawal to contribute to an RRSP or an FHSA. So TFSAs can be awfully flexible for someone who's young, somebody with a low income. RSPs, if you've got a relatively high income or a company match in a group plan, I would definitely lean towards RRSPs.
And thanks, Jason. And Julie, I was thinking, Jason just went over some ideas with TFSAs for younger people, but for older people who maybe have maxed out their register plans, but are looking for a way to lower family income, how can you do that with the TFSA?
Yeah, so max the TFSA. You can also gift your spouse money to put into their TFSA, and there would be no attribution in this case. You can also gift your children money to put into their TFSA. So if they have TFSA room, that's one strategy as well. But the consideration that I would just caution is this is a gift, not a loan. So when you gift them that money to put into their TFSA, it is theirs. And they will make investment or spending decisions based on the assets that they now own.
Right, but in doing so, you would kind of lower family income, a family taxable liability.
Absolutely. If you were to compare it to investing it yourself in a non-registered plan, or gifting it to somebody who could put it into a TFSA, there'd be no tax on anything that they earned in that TFSA.
Thanks, Julie. Amin, I wonder if you could start us off on the next section, which is maybe the newest registered plan on the block, the first home savings account, which was introduced in 2023. I think it was April 2023, actually. Can you tell us, just from a high level point of view, how it works?
This is the FHSA, right?
Yeah, the first home savings account.
So FHSA offers the best of both worlds. It offers you a deduction going in and not taxation going out. So it is you're under the umbrella from start to finish, and it you're allowed to contribute 8,000 per year up to a lifetime maximum of 40,000, as long as you are not living in a owned home and have not lived in a home for the last 4 calendar years. It's a good plan. I've developed a question which basically looks at the pecking order. Let's assume you are eligible for all the registered plans. When I say registered, I mean think of an umbrella and you're earning your investment income under the umbrella, so you're free from annual taxation thereon. FHSA came up at the very top. So once again, if you're eligible for all of them, and let's say you had $7,000 of spare money, FHSA was the most powerful, and then after that, RRSP and TFSA depended on your tax rates going in and the tax rates going out, expected tax rates going out during retirement. And then if you had a very short investment horizon, then maybe RESP and RD, Registered Disability Savings Plans, would be good. But FHSA is a very powerful tool to save money.
Right. Thanks, Amin. Jason, I've seen a lot of questions about FHSAs around eligibility to make contributions or withdrawals, because there's this element of you can't own a home, and also you can't live in a home owned by your partner. But there's a slight difference, I believe, between like when you're contributing and when you're withdrawing. And I wondered if you could just, high level go through what those are.
Sure. So in order to qualify, in order to open a first home savings account in FHSA in the first place, and in order to deduct contributions that you're making, you must not have lived in a home that you own or that your spouse or common law partner owned in the previous 4 years. That's what's considered an eligible first time home buyer. And so that applies at the account opening level, the contribution level. It also applies at the withdrawal level. Remember, an FHSA account can stay open for up to 15 years. So somebody might have contributions they made many years ago. They got into a relationship, they moved into a home, maybe they even got married, and moved into a home that was already owned by their partner and didn't get a chance to use their FHSA account. So you can qualify at various points in your FHSA journey and still not be able to make a withdrawal on the back end. The good news is there is an option, sort of a backdoor, to transfer money into your RRSP account and keep that money tax deferred, even though you can't take a tax-free withdrawal.
Right. And Julie, I'm kind of interested in this question about the timing of when to open an FHSA, because you have a 40,000 lifetime limit, 15 years. My understanding is you can really only have an FHSA once in your life, I believe. So if you're deciding when to open it, or you're thinking about giving your child, just like with the TFSA, the money to contribute to an FHSA, I mean, at at the same time, you want it to run a few years, ideally, so that you could have an opportunity to make some contributions and build it up a little bit. What are the considerations around when you open one up?
So ideally, an FHSA is used to purchase a first home. So
Yeah.
the best time to open one is when you have a plan to purchase a home, or there's a plan in sight, right? The FHSA, the name of it has the word account at the end instead of plan. So it's not a plan in and itself, it's an account to help you accelerate your plan. If you have a plan to buy a home, there's this one important piece that, unlike with TFSAs where you just by turning 18 start to accumulate room, the FHSA actually has to be opened to accumulate room, and you can carry forward 1 year's worth of contributions. So if you know that you're planning to buy a home, consider opening an account, even if you don't contribute to it, say in 2026, that way in 2027, you can contribute for 2 years. So there's a little bit of wiggle room with timing that way. The 15-year deadline, again, if you do nothing and you don't buy a home within 15 years, you're right, you lose the ability to use the FHSA. You can, as Jason explained, transfer that to your RRSP, so you can continue to enjoy tax-deferred growth on that, but you do lose the ability to use an FHSA to fund a home. And one more thing on timing, we've covered this, but I'll just put this reminder here. The timing of deductions does not have to match the contributions. So if you're not in a high tax bracket and you're starting to save for a home, you don't need to take those deductions right away. You can save those for when you're in a higher marginal tax bracket, and those deductions are worth more to you.
Right. So there's no problem with, say, giving your child the money for an FHSA and worrying, well, the deduction's not useful for them because
That's right.
Right, because they can just wait until they have a higher income to take it.
So that the deduction's worth more. Yeah.
Yeah.
And to understand that, you can also use FHSA for your second home as long as you have not owned a home in the past 4 calendar years and you're not living in your own owner-occupied home this year.
Yeah, people might not know that. Yeah, that if you previously were a homeowner, but then sold the home and then didn't own a home for 4 years, I think, and then within the 5th year, then you would be eligible for as a first-time home buyer, as long as you met all the other requirements. So you could be someone in midlife or later in life who's already bought and sold a home and used the FHSA again. And just at the end of 15 years, if I haven't bought a home, what happens? I mean,
You can put it in your RRSP.
and it doesn't affect contribution room.
Right. It's just additional room. So it's really has very limited downside.
Yeah, yeah. I want to move over to registered education savings plans. And Julie, I wonder if you could help us start us here about maximizing the government grants. So the government offers grants, but only a limited amount a year. And there's a lifetime, I think a lifetime limit per beneficiary of how much you could contribute. So how do you approach a strategy for contributing to an RESP?
So a registered education savings plan used to save for a child to go to school. You are eligible for a 20% match on the first $2,500 that you contribute each year. So about $500 per year, but there's a lifetime maximum of $7,200 worth of grants. So that means on the first $36,000 you contributed, you could receive those grants. The lifetime contribution room to an RESP is $50,000. So there's two different strategies you could employ here. You could say, I want to put the full $50,000 because there's no annual contribution limit. There's a limit on which you can get a grant, but no annual contribution limit. So you could say, I want to put the full $50,000 in and have the most amount of time in the RESP, or you could contribute annually to maximize those grants. Up to $36,000, that's the amount you get grants on. There is an additional CESG, Canada Education Savings Grant, for lower income families. And there's also a Canada Learning Bond for lower income families. So this is additional free money, or these are additional grants that you may qualify for.
Right. So this is at the sort of, if you're below a certain income level,
Yeah.
you don't have to make a contribution yourself, but the government will put in. So it's not even a match. They just put the money in.
Yeah. Yeah. It's free money, actually, the Learning Bond. Yeah.
So it's, if you're eligible, it's a good idea to do it.
For sure. Yeah.
Right.
Except, if this would impact very few participants on this webcast, but if you have lots of money outside your RRSP right now, if you put in $50,000 on the birth of your child into a sheltered account, it would have the highest growth, and you would actually feel better that you're benefiting from the tax-free compounding rather than relying on government grants. So $50,000 at the date of birth, even though it does not maximize government grants, the magic of compounding results in a very high portfolio at the age of 18.
Yeah, for those lucky enough to have 50,000.
Yeah, or if there's a grandparent who's wealthy enough and they want to,
Jason, I wondered about at the time of withdrawal, like how does the different, I don't know the right term, but the different income streams that come out of the RESP, you have your contribution amount, you have your growth, and you have the government grants. How do they get treated? And is there a way of sort of like, in what order do you take them?
The financial institution that holds the RESP, the entire balance has different components to it. The original contributions that you made over the years is called PSE, post-secondary education withdrawals that you can take. Again, tax-free. You didn't get a tax deduction on the contribution. The withdrawals therefore come out tax-free. But all the government grants, the learning bonds, the investment growth that hopefully occurred over the years, those withdrawals are taxable. Those are called EAPs, Educational Assistance Payments, and they're taxable as long as the student is studying qualifying post-secondary education, whether it's college, university, trade school, anywhere in Canada, anywhere in the world. Those taxable EAP withdrawals that are taxable to the child, you need to plan for that to a certain extent. It may be that the child has a lower income in their first couple of years going to school because they're not working, they're just getting settled in. It may be that you've had a lot of growth in your RESP because you started early, you invested successfully, and you don't want to leave too many EAP withdrawals on the table for later. So you need to be intentional with the way that you're taking withdrawals, and the financial institution will ask you to provide a breakdown of what you want the withdrawals to be. There are some limitations, but generally speaking, you can have control over the taxable and tax-free withdrawals. So a little bit of income splitting opportunity, a little bit of family tax planning that's involved. But for the most part, college, university, trade school age children have relatively low incomes. And although those EAPs are taxable, you generally don't pay, or the student generally doesn't pay much or any tax on it.
Right. Thanks, Jason. I wondered if we could talk about, deciding where to hold investments, in a registered account or a non-registered account. And I wonder if you could walk through, I know there's sort of three main sort of sources of income, and they're taxed in different ways. And, from a high level, how do you approach where I hold my investments from a tax planning point of view?
Yeah, so you should look at a shelter like you have an umbrella. So what you want to keep under the umbrella are things that are taxed heavily. And investment in the form of interest income is taxed the most heavily. And investments in earning in the form of capital gains are taxed the least heavily. So keep interest earning instruments inside the sheltered plans, and capital gains earning instruments or lower tax favored investments outside the umbrella. In that way, you can have your entire portfolio diversified. And once again, this can also be done across spouses. Let the higher income spouse perhaps hold capital gains earning instrument because they're taxed lightly, as well as not, you can defer the tax until realized. Whereas interest income is taxed annually, and those can be held by the low income spouse, as well as held under the umbrella so it gets sheltered.
Julie or Jason, do you have any follow-up on that particular topic of, because one thing I think about is, the obvious thing is sort of like with registered retirement income funds, you have to take a certain amount every year, so you have to keep part of that liquid. You might need money in an FHSA to buy a home. And so that might affect, what investments you hold. Are there any follow-up thoughts following on what Amin said about tax considerations and registered plans? Either one of you.
I'll jump in.
Sure.
I think tax is important, and tax is a consideration for sure. I think that you also need to consider obviously your investment risk tolerance, but the time horizon, as you alluded to, Rudy. If you've got an FHSA that you're going to take a withdrawal from in a year, you may hold that in fixed income style investments that are earning interest income. So you need to look at the time horizon for an account. And ideally, you're weighing both the time horizon and the tax implications when you're making those sorts of decisions. Lots at play, particularly when you're managing your own investments and you are your advisor. You don't have anyone looking over your own shoulder.
Right. Okay. I wanted to maybe ask a little bit about the principal residence exemption at the end, because we do get a lot of reader interest in it. Jason, could you just go over like what it is? Like, I think most people think, oh, I don't have to pay taxes on my home, but in actuality, what is it?
Basically, a taxpayer or a couple, so that includes spouses or common law partners, in any given year, they can have a principal residence. And if a couple only owns one property, then that would generally be their principal residence. And when they sell it, they can probably claim the principal residence exemption as long as they weren't using it to earn business income or rental income in a significant way. If somebody has multiple properties, that can make things a little bit trickier. You may have some flexibility as to which you claim as your principal residence. And one common misunderstanding that I've seen over the years is people think that they can have a rental property for a number of years, move into it, sell the property, and claim the principal residence exemption and avoid tax. And unfortunately, it doesn't work that way. So, there's some little nuances. Principal residence exemption can even be claimed on a property that is in another country, interestingly. So lots of planning strategies for people who have multiple properties and lots of tax potentially payable if you've owned properties for a long time.
Right. And Julie, just to, I'm sort of finishing out on the question portion here, but if you do rent out a portion of your home, like maybe not all of it, but a portion of it, what are the considerations around the principal residence exemption if I rent out a whole floor or rent out a room?
Yeah, that's exactly it, right? So if you're renting, if this is your primary residence and you're renting a portion of it, it is not primarily a business, it is primarily your residence, then the principal residence exemption or a portion of it may still apply. If it is the way Jason described it, where it is completely a rental property for some years, then you wouldn't be able to claim the principal residence exemption for those years. So it's very important that what it is a principal residence exemption. So if it is primarily your principal residence, then there could be an exemption that applies.
Right. Okay, Julie, thank you very much. We're sort of at the first part at the end, and we're moving into questions. Before I dive into the questions, I wanted to tell the attendees to take a moment to check your inboxes. We'll be sending out a survey regarding our discussion, and we'd greatly appreciate it if you could take a minute to complete it. And anyway, panelists, I wonder if you're ready for some questions I'll toss out at you. The first one is, are there smart planning strategies that make charitable giving more tax efficient while maximizing the impact of the donation? And we didn't look at charitable giving but it can be quite powerful. Does anybody want to jump in terms of things to keep in mind about charitable donations?
I can take it.
Go ahead, Julie.
Yeah, so charitable contributions. So you do get a tax credit for charitable contributions. And so a strategy around, and it's 15% on the first $200 and then 29% after that. So one strategy is that you can pool those contributions for spouses so that you're claiming more of that at the 29% instead of the 15%. And it's better for the higher earner to claim that. There's actually also, depending on your income, a high income credit of 33% for those with income over a certain threshold. You can also, from a strategic perspective, carry unused donation credits forward for up to 5 years so that you can pool them for a larger claim.
Right. Amin, did you want to add something?
Yeah, you can. So if you're giving small amounts each year, consider instead bunching it up and giving a larger amount every other year. Another way is to go back work backwards, how much taxes you're paying, and perhaps contribute an amount such that your entire taxes are forgiven. Tim Sesnick in the Globe and Mail has an article from a long time ago as to how to get there, but that's an approach, because then you don't want to use charitable tax credit carried forward. You just have to keep track of that. So give to the point where your entire tax liability, if you're giving large amounts, until your entire tax liability has been soaked up.
Got it.
I'll add one. You can also donate appreciated securities to eliminate capital gains tax on the appreciation. So you'll still receive a tax receipt for the fair market value, but not pay capital gains tax on the appreciated value of the securities that year. So instead of selling them and then donating the cash, donate the securities.
And that's a real powerful strategy. You sort of double up the tax benefits.
Yep.
We have a question here, and I think it's a bit of a doozy. Do you have general tax planning guidance for individuals who are dual citizens of Canada and the US, particularly with respect to retirement accounts, withdrawals, and ongoing compliance in both jurisdictions. And obviously, we could have a 4 or 5 hour discussion about cross-border, but what are the major, what's the major idea to keep in mind if you are sort of a tax resident of both jurisdictions? What do you have to do, and what do you have to keep in mind? Does anyone want to jump in?
I think the good news is, for the most part, Canadian tax rates are higher than US tax rates. Maybe that's not good news, but the result tends to be that most Canadians who are also US citizens and need to file a US tax return as well don't pay much or sometimes any US tax. The problem is that there are certain types of deductions that can be claimed in Canada that can't be claimed in the US, certain credits that can be claimed in Canada that can't be claimed in the US, certain types of income that you can split in Canada that you can't claim in the US. So I think one of the keys is anybody who is doing retirement planning where there's a lot of tax deferred accounts, a lot of tax deferred income, even capital gains, for example. It's really important to try to collaborate with a cross-border accountant that can look at the Canadian and US implications. The good news as it relates to registered accounts specifically, Rudy, the Internal Revenue Service recognizes RRSPs as tax deferred accounts. So generally speaking, most Canadians who have a lot of their savings in RRSPs are in a situation where the tax implications are comparable between the two countries. It gets a little bit murkier if you've got other types of assets like tax-free savings accounts, which the IRS does not recognize, corporate assets. So again, it makes it a little bit more complicated, but US citizens in Canada have 2 tax returns, 2 tax regimes, and double the planning that they need to do.
So don't do this on your own, is basically the takeaway there.
That's some advice.
I have a question here from somebody who says they have a tax liability, an unpaid tax liability to the CRA. They've received an inheritance, and will the CRA claw back what they are owed, and how would they do this? And I just wonder about, I think this is a question really about how the CRA can, sort of collect what they're owed. Does anyone have an answer there or a reply for the question?
I don't know that the Canada Revenue Agency would go after the inheritance specifically. In other words, they wouldn't prevent the inheritance to come to you in the first place. An inheritance is paid as part of the estate process. The executor distributes it to the beneficiary, but the Canada Revenue Agency does have sweeping powers to pursue monies that are owed. And in some cases, they can and will take money from your bank account. So I think the main thing when you've got a tax debt, though, is to not try to hide. To approach the Canada Revenue Agency, they're pretty reasonable as long as you're reasonable with them. And the best thing you can do is have an open dialogue, because they'll find you otherwise. And the tax debt won't go away on its own.
Right. And I'm here at the last question, last audience question. Somebody asked about, when people think about tax planning, what's one opportunity they commonly overlook? Is there like a common mistake that, that people miss out on?
I'll put one out. I think tax.
Sorry, go ahead, Julie.
Yeah, a tip I would give on tax planning is it's not always the same. So people will put things in place and think that they have a tax strategy. An example would be, contributing to a spousal RRSP and then just letting those contributions stay the same for years and years. My tip would be to sort of review your situation changes, your spouse or your family situation changes, your goals change. So to continuously review your tax strategy and not just assume that it's a one and done.
Right. Okay. Thanks, Julie. We're at the end. We have to leave it there. So on behalf of the Globe and Mail, I would like to thank Julie, Amin, and Jason for being here today. And a special thank you to our sponsor, Edward Jones for making today's event possible. And of course, a big thank you to all of you in the audience for tuning in. We'll display a QR code on the screen, allowing you to complete our survey. A link to the recorded webcast will be sent to all registered participants within the next 2 weeks. Thanks again and enjoy your day.